new. Panics are always at the heart of any bank collapse. But the difference between now and the 20th century was that in the 20th century, they took a long time because people had to go to a bank branch, queue up. You used to see those photographs of people on streets, get bits of paper, and it would take days, if not weeks. Now it's so fast that it's almost happened before you even know it started. $43 billion fled out of Silicon Valley Bank in a matter of hours because people were posting panicky tweets, panicky messages on social media, and it spiraled. And the problem for regulators is, what do you do in this hyper-accelerated world where cyber flash mobs can suddenly explode and can be very hard to quench?
If we learned anything from the 2008 financial crisis, it's that bailing out banks is a bad idea. Consumers and depositors are the ones that need help. When governments give money directly to banks to stop them from failing, they pad their own pockets with rich bonuses, and they do not continue to lend money to consumers and businesses that is needed to keep the economy running. But most importantly, it enforces something called moral hazard. Moral hazard is the notion that if banks are rewarded through bailouts and not punishing them for their mistakes, they'll just continue to do the same risky behaviors in the future. Now, if we learned anything from the 2023 banking collapse of Silicon Valley Bank and Signature Bank, it should be that bank deposit insurance for consumers and small businesses needs to be reformed right now. It is clear that regular consumers and small businesses didn't do anything wrong in dealing with a federally regulated and monitored bank.
The word that gets tossed around, the expression gets tossed around is moral hazard. That is, if you protect these depositors, they and other depositors in the future won't be so careful where they leave their money. And if they're not so careful, this situation is likely to recur. And the implication, the suggestion is that people should do their homework and do research on which are solvent institutions. Now, I won't deny that an institution capable of leaving $500 million in a single depository in a singles bank probably has the wherewithal to do that. But really, in our financial system, do we want to make it the duty of depositors to do that kind of forensic accounting analysis on banks? We don't make people do analysis of airplanes when we board them. We rely on the FAA. If it's certified, we get on them. We do the same thing for drugs that get sold. If they're tested and approved, we rely on it. People aren't doing those forensics by themselves. We might think of extending that to some extent, maybe to a great extent, to deposits and raise that limit.
In the United States, deposits are guaranteed by the federal government up to $250,000. In Canada, it's up to $75,000 US dollars, and in the United Kingdom, it's up to $100,000 US dollars. If a bank goes down in any of these Western countries for pretty much any reason, it's clear that the government is going to step in and help. But as noted, they're not likely to help the banks directly anymore. They're likely to help depositors. Run on the bank is caused by panicky depositors withdrawing all of their money in a short period of time. A run is much less likely to occur if depositors feel that the federal government will insure their deposits and their non-risky investments, like guaranteed investment certificates, are actually guaranteed. In Silicon Valley Bank's case, the United States federal government stepped in on Sunday, and deposits were available to everyone on Monday. That type of quick intervention stops a run. So why is deposit insurance so limited today? To be middle income in the United Kingdom is to make about £50,000 a year. In Canada, that's about 75,000 Canadian dollars, and in the US, it's about 70,000 US dollars. Those types of incomes, deposits from prudent citizens, especially older ones, will far exceed the deposit insurance caps, and as a result, average citizens are often at great risk when a bank collapses. If we want to stop runs on the bank from occurring in the future, it makes sense to have depositors feel safe regardless of their bank's misdeeds and mistakes. If governments are going to step in and backstop depositors in virtually all circumstances anyway, governments should just increase deposit insurance to some modernly reasonable level, like $2.5 million, today. That would stop consumers from withdrawing their money when they hear rumors of problems at the bank. And that may stop many future runs, saving both citizens and economy undue stress and distraction.